All right, so let's start with the SPX, or actually, in this case, the E-mini S&P futures. And so we'll go to the big chart. I'm going to back up to the daily so you can see where we left off last time. We created the structure. The structure is identified by these lines, and you'll see that there are purple lines that outline the nodes, and then there are yellow lines that identify the volume wells or the low volume levels, the lowest levels, these sort of chasms. You'll see these really deep crevices. Those are all impactful. Those are places where the market has found, for whatever reason, a significant area or a transition from one below that level to above that level. And so at that level, even over the course of years, for whatever reason, markets tend to avoid that level. Why? Well, market memory. They remember whatever happened, years past, and they continue on with that same behavior when price reaches those levels. I don't know how you would go about explaining it or proving that that's what happens. It doesn't matter. All that matters is that it does happen, and that by marking it up and then in this large time frame, see, you can see that I'm looking at 2 years of data here. Now, I've only marked up the areas that I'm really interested in, those that are likely to come into play with current price. And so that's why I've only marked up around here. I certainly could go higher up here. So for instance, if I wanted to put another LVL in there above, I could copy and paste this guy here and then place it right inside of that little chasm right there. That would be a good place. One could make an argument that right in here is a good place. Actually, this falling edge is probably even more impactful. So we'll look at that as well. Probably right about there. I think you'll find as price gets up there, you could even make an argument that right here is a good spot. Well, anyways, it looks a little weaker than others. So what I'll do is I'll make it a little bit darker. So I have a little system. I use colors and the thickness of the lines to indicate what the relative strength is or what feature that they're marking up. So when we zoom in to present day so that we can act like day traders, because we certainly can't do it at this level, we'll find that these lines are providing, here you can see support, here we're riding along, this is the edge, these are purple lines, so this is showing inside here is that big volume node, and we tried to break out of it, and this is just one of many attempts that we've tried to break out. If we zoom back out a little bit, you'll see in these few days we've tried to break out into this low liquidity area. Had we breached this other level above here marked by the yellow line, we probably could have gotten into that low liquidity area and started this move upward. Now, we've been trying to do this for quite some time. So if we go back, we'll see that we've been contained by this volume node. That's where most of the volume is happening, and hence we're creating this short-term local node that is really falling in line with the bigger node that has been going on for a couple of years. And the edge of this node is being respected. You see that very clearly. And if we go back, way back, you'll find that the same thing is happening. Now, these levels, the behavior of them, we have behavioral aspects to them too. Generally, when price is inside of a node, it tends to consolidate, as you can see here. And then when it leaves the node, it tends to trend, as you can see here. Very, very definitive behavior. And so by having that in mind, we can create potential scenarios where price is likely to go as it traverses these various volume profile structures. And that's how we develop our support and resistance zones and our potential scenarios, and how we can derive the trades that we may or may not make as they traverse these structures. And so that is exactly how we would do that.